Everyone, it's Daniel here from Infovest. Just wanted to talk about the equity markets, especially S&P 500, Nasdaq, and especially being in August. And looking at the markets and the equity markets since the past couple of days, we've been seeing a rally which is extended from the lows of, I believe it was July. Um, and from there till now we've seen basically a 20% rise. And this is typical in a bear market. You could get a rally that extends from 8 to 20%. Now the question is the bear market, is it over? Are we going to start seeing a rally in the markets? Are we going to start seeing a bullish sentiment that it may look like right now that we are getting? Are we going to get a continuation of it? And is all of this inflation scare and the Fed rate hikes past us? Is it long past us? Are we going to start seeing now all-time highs by the end of the year? And I would say, hold your horses, not too fast. Don't want to jump to conclusions too fast. Just because we've rallied about 20% doesn't mean that, okay, the bear market's over. And you could, again, like I said, a typical bear market rally could go from 8 to 20%, definitely, um, in a bear market trend. So what could it be that brings the equity markets continuing its bear market trend? And the answer that I would have for that is looking at a couple of things. First things first is inflation. Second thing is the rate hike path, which is going to be dependent on the data and the inflation. And the third thing is, most importantly, supply chain. Now, when we look at the equity markets and when we look at also the inflation data, we are expected to see CPI inflation data come out this week, Wednesday, and expected that the expectation is that since we've been seeing oil prices come off, the expectation is we might see a lower number in the CPI print for the US this week. Now, does that necessarily mean that inflation has peaked and now it's going to come off? Some may argue that it has peaked already and we're going to see inflation continue to move down. And is that, signs that you should, or the equity market should be happy because inflation is coming down? Now, the jobs data report that came out on Friday showed quite strength in the employment side of it. Now, one could argue that, you've got good employment, good jobs, good ISM data that's coming out, and inflation's coming off, which means that the economy might not be in a recession, right? And we heard the central bank come out. We heard that the U.S. government also came out and wasn't claiming and calling, even though we have a technical recession in terms of two GDP prints being negative. However, the government and the central bank are stating that we are not in a recession, and just because of the other data that we're seeing, the growth data continues to remain strong, the jobs data continue to remain strong. Now, if it continues to remain strong and inflation continues to be elevated, remember the goal for the Fed is to reach to 2% in terms of its inflation number. Now, if jobs data is good, now we know that the Fed has a dual mandate. It's one, to keep unemployment rate at very low levels, which they're achieving, and second is to keep inflation around 2%, which they are having a problem with. So if they got the first one good, then it's all about bringing inflation lower. Now, inflation is not coming lower, then that's a problem. Then sure, you could say strong growth, strong data means that sure, the economy is absorbing the rate hikes, and they can continue to the Fed can continue to raise rates to bring down the inflation. Now, if inflation is coming off quite a bit, the question would be, okay, does the Fed continue to raise rates or slow down? And if they slow down, how fast are they going to slow down? And do we also get a Fed pivot? So if we don't get any of those Fed pivots, or we don't get a slowdown or a very big slowdown rate cuts, then you could see continuation in fear in the equity markets, and you could see continuation that the Fed might go above the 3.5%, 4% to bring and fight this inflation. So definitely inflation is going to be key data point when we're looking at the decisions of what the Fed is going to do and whether we're going to see a mild or aggressive recession. Now, there's also other signs that you want to take a look at other than just the data, the inflation, growth data. Sure, the Fed's communication is very important. We did hear from two Fed members over the weekend, and some Fed members saying that, don't think that the inflation fight is over. And we did hear from a Fed voter basically come out and say that for September's meeting, 75 basis point rate hike is still on the table. We don't have to do a 50 basis point. And continuation of higher rates and big rate hikes to tackle inflation and bring inflation down is the way to go about it. Now, again, that could change, right? We still have, CPI data this week. We have CPI data next month as well as September in terms of jobs data also. We need to see that. And don't forget that when we get interest rates to 3% in September, there's also a policy lag. And that policy lag basically brings it to 6 months of lag of the interest rate affecting the markets of how and creeping into the economy. And that 6 months, if we count from September, September, October, November, December, January, February. So if we take 6 months, if we wait 6 months, it's telling us that by February next year, we should see the effects of a 3% interest rate creeping into the economy, into the markets. And 3% would make it above its neutral zone where the Fed has where the Fed's target is right now. Because remember, if you're below the neutral zone, you are kind of easing. If you're in the neutral zone, you're not easing or tightening. And when you're above the neutral zone, you're basically tightening the markets, right? So 3% would be above the neutral zone. And the effects of it might be seen in March or February next year. So we may have to wait till, we have to look at data for the rest of this year. We may have to wait till January, February, March to see how data is coming out and how inflation is coming out, and most importantly, how growth and jobs are turning out by the time we get to 3% interest rate. And even as by the time we get to February, March, 3% interest rate, do we start to see those growth numbers, that NFP report, those jobs numbers, do we start to see that start to really come off and come down lower, right? If not, that might hint towards that the economy is doing, a good job of, handling the rates. And if we get inflation coming down as well, and growth is still strong, and inflation comes down to that 2% without breaking anything, then sure, equities are going to move up. But we can't make that conclusion now. We have to wait till we get more job information. We have to wait till we get more information about inflation and data and how interest rates are going to affect the markets. And if it's not doing anything and inflation is still elevated, then definitely you're going to have to fight. The Fed's going to have to fight harder in raising rates. Now, another thing I want to mention is also watch supply chain. A lot of people think that the printing of money is the only reason why inflation has gone up, and that's not necessarily true. We've had printing of money back, a decade ago, and it didn't bring inflation to crazy high levels like we're seeing today. So what really exacerbated the problem was the virus, which led to the government's closing down and shutting down, which led to supply chain disruptions. And we're still seeing that in China, right? Locking down certain areas due to COVID because they have a zero COVID policy, right? Russia-Ukraine war, which is basically also affecting supply chain, right? Also the natural gas prices, that moving up as well because of the cut of supply. And Europe is going around looking for, supply of natural gas. And let's add even another wrench to this problem is the issue with China and Taiwan and U.S. interfering, right? We had House Speaker Pelosi go to Taiwan, which basically pissed off China, and now we're seeing signs that China is basically slowing down its products that they're importing from Taiwan, and Taiwan, exports a lot of these chips that goes into electronics. And Apple came out saying that, hey, suppliers, watch out, don't get products from Taiwan because that's going to slow down our manufacturing and slow down our products and our sales and our revenue, and it's going to make things even worse, which means that prices might go up also, more supply chain disruptions. And Apple also said their iPhone 14 is probably going to be delayed. And if this has a trickle effect, right? And also, if you look at where this tension is happening, it's right on the Taiwan Strait, and that definitely is going to affect a lot of shipping that happens around there, which is going to affect the supply chain as well. So if we do get supply chain being affected by China, and that continues to be the story, that's going to creep into the inflation report and into prices. That's going to creep into goods and chips, and that goes into electronics, and probably the earnings for a lot of technology companies in the U.S. are going to mention that, are going to mention higher prices are starting to creep in. And let's also not forget about food prices, right? Food prices are also continuing to rise, and there's a lot of natural gas and other chemicals that go into fertilizer. And if that starts to also creep in and we start to see shortages and prices start to move up, that's going to affect a lot of economies around the world, and that's going to also creep into the inflation report. So we're not out of the woods. We still need to look at the data. We need to look at supply chain constraints. Unless if all of these are being solved and inflation is coming down, then sure, you could argue that the bear market is over. But until then, right now, there are signs of risk in the future that could exacerbate or keep inflation elevated. Let me know what you guys think. Leave a comment below, and I'll see you guys around. Bye.